I think very, very definitely facing the end of this fiat currency era in the same way that you had the crisis over the Reichsmark over 100 years ago. The dollar's going down, which is why gold is going up. The whole of the US financial system is in a bubble. And this is perhaps most noticeable in the equity market for those who care to look for it. And when that bursts, it doesn't matter who is running the Fed. It's just going to run around and go into infinite QE to do whatever is necessary to ensure the system doesn't fall over.
Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com. And before we start, do remember to subscribe, like, share, and do comment. We're always very interested in your comments. Now, today I'm very pleased to say that I have my friend Alasdair Macleod, who is the founder of the Macleod Finance Substack, a very influential Substack. And he's here to explain to us all about the volatility, the extreme volatility that we've seen in the gold and silver markets and other aspects of the world economic situation, which is certainly pretty volatile. So, Alasdair, can you explain what has happened with the gold and silver markets and what does it mean for investors?
Well, the volatility has actually coincided with the end of the February COMEX contract. Now, the reason that's important is that if you have a build-up of speculative positions, then that is the time when the shorts, who generally are the swaps or the bullion bank trading desks, that's when they shake the trees. And that's more or less what we saw. The situation, I think, is compounded somewhat. There are various factors we have to consider. The first is the level of speculative interest. It is extremely low. So I doubt that there was very much in the way of long positions actually shaken out. When we look at what happened on Monday, there was a markdown on Monday, particularly in silver. And this coincided with the end of the options, the options for February, because that was the day, if you like. So they wanted as much as possible to get these options, call options, out of the money, so therefore worthless. So that explains that one. The big slide, which really started in the very early hours of Friday morning, had more to do, I think, first of all, there was a little bit of profit taking in China from the very high levels that we saw ahead of the weekend, which, any sensible punter, if I can call them that, would take his profits ahead of the weekend and say, well, Monday is another day. So there's a little bit of that going on. But the key point is that once China had closed, basically there was no interest from the Far East. And the swaps on COMEX, the members of the LBMA, the dealing banks on the LBMA, really had a free run to do what they wanted. And in the absence of really any meaningful speculative interest, they were able to make the price whatever they wanted. And that's basically what they did. And the reason that it was on Thursday, Friday, was that going into Thursday, the open position in the February contract was around about 38,000 contracts in gold. Now, not a huge quantity, but, enough. The point is that Thursday was the first position day. Now, what that means is that if you have got a long position on COMEX on that day, you could well be allocated, if you like, stock, which, physical stock, which you would have to pay for. So basically, you need to, unless you actually want the stock, and most dealers don't want the stock. They're just playing the market. You have to get out. You have to sell your position. You either make a loss selling your position, or alternatively, you roll it into the next active month, which I think is April. Now, even if you roll it into the next active month, you've got a mark-to-mark loss. So you can see that all this is conspiring against the few speculators that were left, if you like, in that contract last week. And it just went from there. I mean, they just banged it as hard as they could, because remember, you're looking at a mark-to-market effect as well. And I think what it confirms is that the establishment, if I can call them that, swaps on COMEX, the dealers on the LBMA, the banks, the bullion banks on the LBMA, having been net long of gold last year, across the two markets, I think they'd lost that position and they were going short in gold. And also, of course, they're being very, very badly squeezed in silver.
Exactly. So, we heard a lot about silver.
Yeah, exactly. So on that basis, I mean, they could make more or less any price they liked. And that's what happened. The effect this morning, obviously, China wakes up and says, oh, my goodness, look what's happened. And of course, the other thing that hasn't actually helped the speculators is the gradual increase in margins that they've got to place when they buy futures contracts. So that, I think, has also helped unwind potential interest, if you like, in futures. So they wake up this morning and find that everything's been marked down heavily. Now, having said that, in China, silver closed around about 103, I think, and then 111 on the futures exchange. Gold closed at something like 5,200. So we're well below where they closed in China. But the important point, Jasmine, is that now that expiry of the February contract is behind us, the reasons why the market crashed are also behind us.
Right.
Now, I think it would be a mistake to say, well, we've definitely seen the bottom and all the rest of it. But I think the likelihood is that we have seen the bottom. It's been a flash crash, if you like, engineered by the establishment, who are getting desperately worried about their book positions. And I think that's what you've got to focus on. Where is the interest in this? And the interest basically is the establishment wants to get their books on the right position. And I doubt if they actually shaked out very much. But what they didn't get out in terms of contracts, I mean, I saw, for example, gold's open interest on Friday, and provisional figures fell by something like 25,000 contracts. I mean, that's not huge. But what they didn't get on that side, they got, if you like, in terms of the fall in the price of gold, silver, and all the rest of it. If you like, the price effect was out of all proportion to what they actually achieved. So we go into this week with the immediate aftermath perhaps behind us. And I think that we should see prices begin to recover this week. And then what I would bear in mind is that what has not changed is the background to why precious metal prices rose in the first place. I mean, you've got an enormous debt situation in America. Debt to GDP is, 125, 130% or something. But the point is they've got to roll over an awful lot of debt in this year. And it's going to get rolled over into short-term financing, US T-bills, that sort of thing, a lot of it, because there isn't the market at the long end. Not only that, but America's geopolitical maneuverings over Venezuela and Greenland basically, I think, will make foreigners, foreign governments in particular, and foreign investing institutions wary about subscribing for new stock. And that goes both for new debt and also rolling over existing debt. So you've got potentially, I think, a bond market problem, which, of course, then leads on to the equity bubble. Mm-hmm. Definitely a bubble. If you look at the amount of credit that has gone into the equity market, it is a bubble, full stop. So, that is also likely to unwind. And when that happens, in fact, I would say it's definitely going to unwind. It's just a matter of when. When that happens, you've got to think, it doesn't matter who the head of the Fed is. their duty basically is to try and rescue the market, secure the integrity of the banking system, and stop any of these sort of debt zombies, the major ones, the important ones, going bust.
Well, quite. I mean, in your latest McLeod Finance Substack, you mentioned the potential that the dollar has to be like the Reichsmark back in the Weimar Republic. I mean, your graphs show remarkable similarity between what gold and silver was doing in those times and what it's doing at the moment. So, and you were saying that we're likely to have more volatility in the gold and silver markets in the run up to essentially the destruction of the dollar.
Yeah, that's absolutely right. I mean, the volatility in those days, which actually doesn't show in my graph because that was a long-term graph, was reportedly, and someone put up a graph of this on X, which I can't verify. But I mean, they were saying the volatility of sort of 30%, sort of quite frequent. Now, I don't know that I could really endorse that because the figures didn't originate with me. But I think the point is that as gold goes from, and if you look at it from the point of view of the gold price rather than the collapsing value of the currency, as gold went from 90 Reichsmarks to the ounce to in fact, it was more than 4,000 trillion because that was the gold mark's rate of exchange with the paper Reichsmark at the end in November the 23rd, 1923. I mean, you're with moves of that sort, you are going to get volatility. It's really quite simple. I mean, we also had a situation where in 1920 and through to 1921, the end of 1921, there was a lot of stability in the value of the Reichsmark. And in fact, it was the best performing currency in the world, very, very briefly, going up something like 50%, 50% against the gold-backed dollar at that time. And that's despite of what subsequently happened. And of course, the other thing is that by December 1921, sorry, I get the century right. By December 1921, there was a market crash. Now, the market crash was only worth 25% in collapsing Reichsmarks, but in gold, it was like 93%, just bang, like that. So you can see that these are not normal times in terms of valuing things, if you like. We are, I think, very, very definitely facing the end of this fiat currency era in the same way that you had the crisis over the Reichsmark over 100 years ago. On that basis, unless someone steps in and does something about it, then the dollar is going to go to zero.
Now, you and I were speaking just the other day, and you mentioned that Tether, which is the main stable coin connected to the dollar, most of the stable coins are connected to the dollar, of course, and Tether is the one that people know, if they know any of them, that it is buying gold, which seems extraordinary to me. There you've got essentially a crypto coin which is connected to the dollar, but it's buying gold. What's happening there?
I think you have to understand what Tether is. Tether effectively is credit in exactly the same way as a balance on your bank account is credit. It's credit owed to you by the bank. It's the bank's property owed to you. Tether, sort of coins, if you like to call it that, they're exactly the same. They are credits. They are a currency, a form of currency. They work differently from bank-generated credit, insofar as it's rather like a deposit, if you like. So if you, let's say, want to buy some Tether, you can buy some Tether. The Tether is then issued to you. On the other side of the balance sheet, that will invest in something. Now, usually it will be US T-bills. So they issue the coin to you, Tether, and for no yield. And on the other side of the balance sheet, they're picking up 3.5%, 3.75%. Nice business, yeah? So That's the way in which it works. Now, the boys at Tether obviously come to similar conclusions to me, and that is that the dollar's going down, which is why gold is going up. So if the dollar really does go down, our business is ended because there's no point. So I think what they're doing is they're buying gold with a view to maybe having a gold-backed currency in effect as the dollar goes down. I think they can see the direction in which things are going. So their best hedge to keep their business going is actually to buy gold. And then at a later stage, what they will probably do is instead of issuing more Tether attached to the dollar, they will issue Tether attached to gold. It will be a different coin, if you like. I mean, coin is very much in inverted commas because there's no physical presence. There's another form of credit. But as long as they can tie the value of that credit to gold, then it will maintain its value.
It's remarkable. And, speaking of the death of the dollar, I mean, we're talking about the death of fiat currencies generally, but, the dollar is motoring ahead. Most people a lot of people seem to be putting it on Donald Trump. I mean, Donald Trump is a great place to put any sort of blame as far as I can see. So how much do you think it is his fault, and how much is it just an inevitability? Is he just an accelerant to what was already happening? I mean, because it does seem that the dollar and fiat currencies have been dying for a while now. Yeah. It's not just under Donald Trump.
Yeah, I think accelerant is the right word. I mean, he's a spendthrift. Let's face it. I know all this stuff about Doge and all the rest of it. I mean, forget that. That's gone. He had his big, beautiful bill and all the rest of it. And it looks to me as if the deficit is on its way to about $2.5 trillion in this year to end September, which is their fiscal year. And he's also pushing for lower interest rates, which is interesting given his appointment of Walsh as the replacement for Jay Powell. I think Walsh is probably a chameleon, if you like. He will change his color to suit the president. I mean, that actually that's not make any difference, because the fact of the matter is that the whole of the US financial system is in a bubble. And this is perhaps most noticeable in the equity market for those who care to look for it. And when that bursts, it doesn't matter who is running the Fed. It's just going to run around and go into infinite QE to do whatever is necessary to ensure the system doesn't fall over. And of course, what happens is that the dollar collapses when under those policies.
Yeah.
So, it's going to happen. And I think that certainly, I mean, Donald Trump, to be fair to him, like any other politician, doesn't actually care about the indebtedness of the nation until it becomes a problem. And then, where will the priorities lie? Well, I think the answer is quite simple. The priorities will lie on existing policies, not cutting back on public spending and getting the economy onto a stable basis with a budget surplus and all the rest of it. I just don't see that. I mean, that's not the political imperative. Politics is more important in a currency collapse than economics. It's actually as simple as that. And not only that, but you have a whole generation of economists in America who actually don't understand the difference between money and credit. They think the dollar is money. It's not.
Yes. Absolutely. I think it's very true. So, I mean, we have seen the S&P 500 and the FTSE do extremely well in the last year or so. And I mean, I'm reminded of just before the 2008 crash, again, stock markets were doing really pretty well generally. So it seems to me, and I can't, neither of us can tell investors what to do with their money, but it seems to me that now might be a good time to take some profit and just sort of move at least some of one's money out of these stock markets. What do you think?
Well, hubble, bubble, toil and trouble. I think, you're right. I mean, anyone who doesn't do it will live to regret it. And the important thing is to understand the difference between credit, which is not attached in its value to anything other than the expansion of its quantity, but more importantly, the faith that people place in it. So, it's completely different from real money, which, going back to Roman law and in all our common law, real money is gold. And that is what is accepted. That is why central banks have been piling into gold. They've been selling dollars effectively. And that's probably the better way to look at it, rather than saying that they're buying gold. Yeah, they want out of paper currency. Now, these guys know a thing or two. They may not admit it, but they do understand the difference between credit and money.
And speaking of real money and credit, the yen is looking interesting at the moment. It seems that every time their prime minister says something, the whole market wobbles, and they had quite a wobble. Particularly with the bond market a week and a half ago. What is the situation, do you feel, with Japan, and how is that affecting us, affecting the rest of the world?
Yeah, well, if you like, the ghost of Liz Truss walks in Japan. I mean, she's talking about reflating. She's holding a snap election to try and get a mandate to do it. And reflating basically means expanding the budget deficit, issuing more debt, driving up prices, which are admittedly slower to respond to the expansion of credit in Japan than they are, say, in the UK or indeed in America. But that's because people tend to save more than in Japan than we do. But the effect of that is going to be to drive up inflation. And the Bank of Japan has got no option but to raise interest rates. They're already looking at the highest interest rates for however long. And as to how that affects the rest of us, of course, the Japanese institutions, insurance companies and pension funds have invested outside the yen in order to enhance their returns. And this is why they're collectively, they're now the largest holders of US Treasury debt. Now, if you look at the yields on the long end of the JGB market, I mean, we're up to 4% on 30 and 40-year bonds. So suddenly, it means that it's less attractive, if you like, to invest in the dollar. And the other thing, of course, which is killing investment in the dollar, is that this change, if you like, in the relationship between interest rates in the US, which President Trump is still trying to talk down, and interest rates in Japan, is being reflected in the currency. So you've got the yen rising against the dollar, which basically means that unless you hedge it, which of course takes much of your profit out of the trade, the idea of borrowing yen, selling yen to buy dollars, and then investing the proceeds in US treasuries suddenly isn't quite so attractive. And not only that, but you find that the Japanese pension funds and insurance companies who've put money into US treasuries and also into some of the Eurozone bonds. I mean, they were very long of France at one stage. I don't know what that is now. That is less attractive as well. So these capital flows, which have kept the rest of us financed, basically, are diminishing. And that's going to lead to higher bond yields. It must do.
And it's happening in the UK as well. I mean, there are a lot of Japanese investors in the UK bond market, I believe, and they're going to be pulling their money out of there as well. Nothing is as attractive as increasingly as the Japanese market.
Yeah, that's right. And indeed, the Bank of England has issued several warnings, being worried about the level of foreign interest in gilts. They refer to hedge funds in particular. And yeah, that's right. I mean, the hedge funds have been, picking up on the yield. And very often it's been, they've been selling short to buy long, going out along the yield curve. At some stage, when there is a financial shock, which will probably come from America, despite our wonderful government, we will find that sterling will come under huge pressure as everybody scrambles out. I mean, it's actually, and this is what the Bank of England is actually very, very worried about, and I think rightly so.
It does feel that, as you say, there's America in a big bubble. It feels like we're in a bubble, that the whole world is in a bubble and a massive credit bubble. Even China is indebted. Every single country seems to be indebted. You think, well, who are they owing to? And this is what I often get asked. Who's lending to us? And much of the time it seems to me that we're lending to ourselves, certainly with China.
Yeah. Well, yes. I mean, if you look at America, they are very dependent on foreign investment, foreign investors, if you like. So that is bad. We are in a similar situation. The Eurozone probably slightly less so because, being a group of sort of countries, I think quite a lot of the investment, for example, in French oats, comes out of the German banks, if you like, or the customers of German banks, doing a sort of interest rate swap. I think I see your point about that. When it comes to China, interestingly, virtually all her debt is internally financed. So she's less exposed to these, cross currents, as it were. The level of central government debt in China is actually relatively low compared with their Western comparisons, I suppose. Yeah. So that's one thing. I mean, there is quite a lot of debt in the private sector, but apart from what's, I think, gradually being written off from the property crash, most of that debt is actually productive debt. It is borrowed by companies actually making things to sell profitably. Now, that's something which we're rather lacking, I'm afraid, in our economy, and also it's the same problem in America, which I think is one reason why Donald Trump is trying to talk the dollar down.
Well,
he doesn't seem to realize, talk the dollar down, and the foreigners aren't going to buy your debt. But anyway.
He's doing it anyway. Well, in a sense, so is the Japanese Prime Minister. I mean, she had to sort of correct herself today and say, well, I wasn't saying that her low yen is a good thing. No. So it's understandable. But yes, I agree that our debt in the West seems to be primarily to fund benefits, social payments, whereas, as you say, in China, their debt is more productive. But the whole debt bubble that we're in, as you've said, and it has, at some point, it's got to burst or at least change in some way. So it sounds to me like the best thing for investors to do, gold and silver, is to hold on to what they have and possibly buy more while it's cheaper.
Yeah, I mean, what a wonderful opportunity. Did you ever think that you get the opportunity to, you might have missed it. So it's like, oh God, I wish I'd put more in. Now you can go in and fill your boots. I mean, get out of credit. What a wonderful opportunity. You've got to look on the bright side. And I think that's the sensible thing to do because, there's absolutely no change in the long-term risk. And by long-term, I think we're probably talking no more than 18 months now. I mean, I think this collapse could happen really very, very quickly.
Yes.
What a wonderful opportunity to hedge out of it. So go for it.
Well, I've been saying, like one or two other people, that I think that gold is going to go to $10,000, $10,000 per ounce, possibly the end of this year. It just feels, as you say, like the Reichsmark. It could go a long way, a staggeringly long way.
Well, the way I look at it is not so much the dollar going up, but the currency going down. And unless someone can convince me that there's going to be a politician or the central bank can take charge and actually protect the currency, well, it's actually not the central bank, it's the US Treasury. Unless they really balance their books, throw up a credit, a positive number on their on their budget, then gold goes to infinity, measured in these dollars. Why? Because the dollar goes to zero.
Yeah.
The gold will retain its purchasing power. It varies a bit, And there's another thing, actually, in all this. Gold has been running ahead of other commodities. The result is that commodities are extremely cheap priced in gold. They are going a lot higher And when you bear in mind that they're going to rise, I would say probably 3 or 4-fold at least in gold, in a declining currency, the price effect is going to be even more dramatic. So what's that going to do to inflation? Do we hear anyone talking about inflation in 2026? I
No,
don't.
no,
I
good
mean,
point.
I think we could see from the middle of 2026 onwards, we could well see inflation soaring to over 20% in the UK and also in the US. Why? Because of the currency effect.
Mm, mm. Yeah. So again, commodities generally, not just the money metals, not just gold and silver,
Yeah,
but
base
all
metals
the
as well.
commodities.
Yeah. And I think the other thing is oil. And you never know, our dear President Trump might tip the price up if he starts attacking Iran, because Straits of Hormuz will be closed and oil will spike up to who knows where.
Interesting. So
Yeah.
for investors, really, it's commodities as a whole, particularly the money metals, but
Yeah.
we should be looking at, as you say, oil, agriculture, all the base
Yeah.
metals,
Yeah.
etc.
Yeah.
All worth considering.
Yes.
Alasdair, thank you so much for all of that. This has been Alasdair Macleod, who runs Macleod Finance on Substack, an excellent Substack to subscribe to. I know it's a very, very popular one, Alasdair. And thank you very much for this explanation of the situation at the moment. And if you have any questions or comments for Alasdair, do comment on this video, because we do check them out, and I will be sending them to Alasdair to answer as well if there's anything that we can't answer. So do remember, as I said, to subscribe to Money Magpie Finance, comment, like, tell all your friends, and I'll see you next week.